Welcome to Idea to IPO. Hi, my name is Rob. I organize Idea to IPO. We've been doing events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 350,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 3,400 events. By any standard, not yet, by any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. Now, back in the day, I used to get a standing ovation, but I know we're coming out of the pandemic, so I'll take it. We hold venture capital panels, legal workshops, networking events, and more. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that's practical, actionable, and relevant, stuff you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley is a global, aspirational ecosystem. It attracts people from all over the world who come here to do great things. Who here is not originally from Silicon Valley and the greater San Francisco Bay Area? Raise your hand. Who here, we'll see, who here was born and raised in Silicon Valley and or the greater San Francisco Bay Area? 3. Well, welcome to you 3. Welcome to Silicon Valley. So whether you're born and raised here or just arrived last night, it's important for us to provide multiple channels for you to meet people, build relationships, and grow your network. We have an event nearly every day of the week. Check out our schedule at ideatoipo.com. With regard to value, it's important that we provide value at each and every one of our events. Not just value for your money, which is important because we know many entrepreneurs are struggling financially. So we make sure our events are affordable. And if you cannot afford the cover charge for whatever reason, come talk to me and we'll work something out. And at each and every one of our speaker events, we provide a delicious buffet meal. Is that a delicious buffet meal? What about the rest of you? So anyway, I want to thank Procopio for sponsoring the bulk of that delicious buffet meal. So let's hear it for Roger and Procopio. Credit where credit is due. I sponsor the watermelon at each of our events, and I pick it up from Costco, and it was prepared by our gourmet chef, Wheezy. Let's hear it for Wheezy. Stand up. So that man is responsible for the delicious watermelon that we're partaking in. More importantly, though, at each and every one of our events, we want to make sure that we provide value for your time, which is your most valuable resource. I have to ask, is anyone here getting any younger? Besides our moderator and our panel? So when you invest your valuable time to come to our events, we want to make sure that you maximize your ROI. So we have many partners that help us do what we do: law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, co-working spaces. Lots of players in the Silicon Valley startup ecosystem. Tonight, we're grateful once again to Procopio for hosting us at this beautiful venue. Is this a beautiful venue? So let's give it up for Roger and Procopio. Applause. Stand up. Oh, I thought you were something.
Yeah. You want me to say something?
Thank you for sponsoring.
Yes, you're welcome. No, well, I'm going to pay for dinner now. So we're a law firm, multiple cities, hundreds of lawyers. I'm the leader of our emerging growth and venture capital practice group. So I help companies start, get funded, and sold or IPO'd.
Short and sweet. Well, thank you, Roger. A few of our other partners are here tonight. I would like to also have them come up and say a few words. Let's hear it for Chloe, Anonymous. Applause.
Hi, everyone. I'm Chloe. I work at a company called Onimus. We take the notoriously not fun process of app development, web or mobile, and make it a little more fun with a toolkit with all the essential features for app development. So if anyone's developing tech, come talk to me. We do a bunch of other things, too, and help startups in a bunch of other ways. So would love to learn more.
Okay, next up, we have Patricia with Graham Adair. Applause.
Hi, I'm Patricia. I'm a partner at Graham Adair. We are a business immigration firm specializing excuse me, if specializing in biotech and medical field. And if you have any questions, I'm over in the back, so please come on by.
So, though our mission locally is to support entrepreneurs in Silicon Valley, our global mission is to democratize entrepreneurship and innovation all around the world. To that end, we maintain a robust YouTube channel, youtube.com/idea to IPO. Check it out. We have tons of videos there. This rich, valuable content is available on demand, anytime, anywhere, totally free of charge. Our partner in this endeavor is Tim Jeggers of Jeggers Films, one of the top professional videographers in Silicon Valley. Tim, come on down.
Thank you, Rob. Thank you, everybody. So yeah, I've been partnered with ID.IPO for several years now. I do everything from content and brand identity development for individuals all the way up to enterprise and commercial size companies. So if you have any questions about all of that, I know entrepreneurs tend to have lots of questions about multimedia and all of that. So yeah, I'll be around. I'm filming. The cameras are both going, so try to not stand in front of that one back there. Thank you.
So here's the schedule for the rest of the evening. Our panel will have a brilliant, compelling, dynamic, entertaining, scintillating discussion. Is that right? Yeah. No pressure. But they'll wrap up their discussion at about 8 p.m. We'll open it up to audience questions at that time. We have a mic stand set up, so I'll go over the logistics when that time arises. We'll take Q&A all the way up till 8:30. We'll end the formal program. You can stick around, network, socialize, and connect. As a courtesy to Procopio, we would like to leave the building at 9 p.m. However, there is an after party, and I'm going to put it out there. There are 3 options, and we'll revisit that later. There's a Rosewood. It's Thursday night. The patio. Pizza My Heart. I was going to mention McDonald's next door, but we'll skip that one. So anyway, think about it. We'll revisit that at 8:30 when it's time for the program to wrap up. So that being said, I'm going to pass it off to our distinguished moderator, Roger Rappaport of Procopio. So let's give it up for Roger and the panel. Applause.
Great, thanks, Rob. Really looking forward to a great evening tonight, and welcome everybody. Appreciate you all coming out, and the fact that we don't have any rain tonight, you guys are all good luck. So not like the last couple of nights. So what I thought we'd do firstly is just go around the panel. We'll start with Ashmeet. Maybe you could just introduce yourself, and then we'll go down the line. Tell us a little about your background as entrepreneurs, technologists, and now as investors.
Thank you, Roger. My name is Ashmeet Sidana. I'm an engineer at heart. I worked as a founder and CEO, ran a company for 5 years, and then worked as a product manager. Probably the product I'm most proud of is VMware ESX Server, doing a few billion in revenues now. I was the original director of product management, ran that till about 300 million in revenues. And now I've been doing venture capital for the last 12+ years. Currently running Engineering Capital, which is a seed stage venture capital firm, typically investing as the first investor in companies taking high technical risk. I am investing my 4th fund. It's a $75 million fund. I only do software. So it's a little bit of a narrow niche, but I have been doing venture capital in different areas before this, and I'm happy to talk about it from all of those perspectives.
Good evening. My name is Alex Marquez. I am also an engineer by trade. I started my career in corporate venture capital at Intel Capital back in 2000 timeframe, so I've been doing this venture thing for the last 23+ years. Spent some time at Intel Capital. After that, I started my own company in the app analytics space, which we sold to App Annie, I don't know, several years ago. After that, I was running USAA Ventures as well for a couple of years, and then after that, I joined Experian to run their fund. We currently focus on everything in the financial services industry, so it's a very broad mandate for whether or not it's payments, it's fraud and identity, it's even some stuff in crypto, and as well as some verticals that we invest in around healthcare and automotive sectors. The fund itself is about $300 million, but it's an evergreen fund because it's a corporate fund, obviously. But we lead rounds, we take board seats, we never go above 20%, but it's very strategic in nature, so it's a dual mandate initiative where we're looking for both strategic and financial return that's consistent with, very strategic, trajectories or, new opportunities we're pursuing. We've done it globally. We have about 45 companies that we've invested in over the last 6.5 years. And so that's kind of the summary on myself.
Thank you, Rob, and thank you, Roger. My name is Sanjeet. I'm the co-founder and chairman of UFirst Capital. I was also at Intel Capital prior to creating UFirst Capital. And we invest primarily in B2B software and like to do early stage, but we are a little flexible. So seed to Series A is really our sweet spot of late. The kind of companies we have done are a company called DevRev, which is creating a developer-focused CRM created by Nutanix founders. Trust Machines, a company out of Princeton, a CS professor created a company out of Princeton for developer infrastructure. We've done 20 investments in the last 3.5 years and continuing to invest more.
Thank you. Well, it's great to be part of this great panel. My name is Ephraim Lindenbaum from Advanced Ventures, and I'm a recovering entrepreneur. I started my career here in Silicon Valley before I knew any better, started a company, grew that through the 90s, not to date myself, I was really young back then, and then ultimately exited in the first dot-com boom, so have been through all the cycles you have on the other side of the room, all the entrepreneurs out there, so I feel your pain. And then I've been a venture capitalist since 1999, was one of the co-founders of Advanced Ventures. We invest in technology, health, and wellness, which for us means a lot of different categories: fintech, health tech, food, agriculture, and clean technology. We're one of the last folks still doing that. And in turn, we've been investing now, as I mentioned, for about 23 years. In turn, we've had an exit about every 14 months throughout the life cycles of our 4 funds. And we've been really blessed, so we're either gluttons for punishment or pretty good at what we do. We typically invest in the earlier stages of a company, typically the first institutional round. We do look for some key indicators: a finished product, a well-formed management team, and typically some level of customer reference, whether that's revenue generation or at least MVP product evaluation there.
As I mentioned, my name is Roger Rapport. I'm actually also a recovering entrepreneur. I did a startup for 10 years. And made all the mistakes in my books. I just tell my clients, do what I didn't do or do what I did, and you'll be fine. So that's also some of what forms my perspectives. Maybe we could just go down the line real quick, because I don't think we captured this. You come in early. Do you lead? Do you follow? And what are the typical check sizes that you write?
$1 to $3 million, almost always the lead, and if 2 people and a PowerPoint is the typical stage for me.
We have invested anywhere between about 500,000 up to 30 million. So we have gone, I say, stage agnostic, and we do lead, but we never go above 20%.
We like to lead, but it ends up happening, I would say, 50% of the times. Our check size average is roughly 3 to 5 at this point. We have done up to 7 million per company as well. And stage-wise, seed to Series A.
Yeah, we're typically the first institutional round in that can either act in a late seed or typical Series A. We typically invest in syndicate. We can lead. We really view venture as a club sport. So for us, we'll take the lead. Some other folks will take the lead. It's really who's got the heavy lifting of writing the investment thesis. We'll probably try and pawn that off on anybody who'll do it other than us.
Excellent. So let's dive right into the meat of it, and let's talk a little bit about the venture landscape in 2023. And as you think about that, maybe also just talk a little bit about the SVB situation that just happened and how you guys think that may or may not impact the landscape in 23, or maybe even beyond. Let's open it up.
I guess I'll go first. I think SVB, obviously the immediate direct impact has been mitigated by the government. If you have money on deposit, you're going to get it back, and I think that's pretty much taken care of. But I think most people underestimate how systemic, deeply ingrained, and valuable Silicon Valley Bank was as an institution in Silicon Valley. It really was the heart of Silicon Valley in some ways. in terms of not just the financial infrastructure, but the very startup infrastructure that existed, which is why so many companies, so many VCs banked with Silicon Valley Bank, and they did things that most ordinary banks are not willing to do. So, for example, early liquidity for founders, getting someone a mortgage, buying someone out if you have to fire a founder. All of these are things which I've done with Silicon Valley Bank. So I'm really going to miss it, even if it survives and somebody buys it and the structure of it comes out. I'm really going to miss Silicon Valley Bank.
Do you think it's impacting the funding landscape?
Yeah, certainly. I mean, I think at this point everybody's taken a long pause. Any of the funds, we were not directly affected, but many of the funds that had their capital there is doing a lot of reassessment. I think that was a very shaky moment for a lot of people. I think a lot of founders. I feel that it was bailed out a little bit quick for many of the founders to really make the necessary steps they should be making now. So I think we are seeing some change, but it's going to take a while. The other thing that I think most folks aren't aware of is Silicon Valley Bank pretty much drove the entire California wine industry. In fact, globally, the wine industry. In fact, they were the fundamental baseline for all of the wine industry. That is decimated because these people aren't financial experts like we are in Silicon Valley. We can just flip over to JP Morgan or some other place. When you've got a significant amount of debt with a lender like that, they wrote the, in essence, report on the industry. That's where there's going to be a lot of challenges. So it will ripple to the point throughout a lot of areas. Many of you folks are not late stage companies, but the venture debt aspect is going to be very, very challenging in the later stages.
Yeah, I think to the last point mentioned here, I think venture debt is actually a key direct impact as well to startups. Silicon Valley Bank almost had a template with quite a few VCs. They said, hey, if you invest and lead, let's say you did a $20 million Series A round, we would give a term sheet for venture debt for 30 to 40% of that round. So the founder, the startup would get additional capital, and it's non-dilutive. So startups loved it too, and VCs loved it too because it extended the runway. It gave more time for a Series A startup to be ready for fundraising, to get ready with the Series B metrics, and hence for the next round and so on. And typically those venture debt term sheets were for 1.5 to 2 years, but Silicon Valley Bank would extend it. Come the time, they would look at the numbers, they would say, hey, how is the revenue looking, et cetera, and even for VC relationships' sake, they would extend it. So they were liberal, I would say, in that respect. I always wondered about the business model on the bank side, but that's a different story. On the startup side, it was beautiful, right? So I think there is going to be a direct impact to startups because of the venture debt model probably going away. There were a few other banks, Co-America, Bridge Bank, maybe a couple of others, First Republic, little bit, but 90% signature, 90% of venture debt model was driven by Silicon Valley Bank. So now think about it. If I am a startup that had a line and I had not drawn, it's like your home equity line of credit, the HELOC. You had it. Remember in 2008, HELOCs went away? Anybody had that experience? If you had a home equity line of credit in 2008, some banks went away. And because of the overall recession, mortgage recession, the home prices went down. The bank sent a letter, sorry, you don't have that line anymore. Very similar thing is going to happen to startups here because of the Silicon Valley Bank crisis. So if you have not drawn, likely that line is going to go away. Which means now the startup has to go back to VCs. So there's going to be more pressure on fundraising from VCs, and startups may not be ready for the metrics of the next fundraising round. They were planning for raising around in maybe 6 months or 1 year from now. But now they have to do it sooner.
Yeah, I think it's a real problem, especially where we were counting on venture debt to extend the runway, to get to that inflection point, and now you don't have that, and it's creating a lot of issues because when you're going out fundraising and you're not at that inflection point, it's going to hurt in the valuation.
I think exactly.
I was going to say, fortunately, we're in Silicon Valley, which apparently has the solution for every problem. So I expect there'll be, this void will be filled. So it's just it's an unfortunate blip in time. I think it's more unfortunate from my perspective that the bank that was the very backer of the startups was actually also the recipient of being, taken down by the startups that they backed in terms of from a bank run. So that part's unfortunate, and I'll look back on that 10, 20 years from now and say I was part of it. But Look, I think it is what it is. We'll move on. There's always someone else willing to step in and fill that shoe.
There is one more impact that I think is not being talked about, not just in this panel, but in general in the news also. And this is an impact to international startups, startups that are created by founders who are not in the US. So think about a founder in Japan, in India, in the UK, etc. They do not have a US social security number. Where do they bank? If they want to enter the Valley, they would first go to Silicon Valley Bank. And they would get an account and the relationship going without a social security number. A traditional bank in the US, Wells Fargo, Bank of America, would probably not be able to help you, especially if you're a startup. So there are several impacts. There's actually a cascading list of impacts that we're going to see due to the Silicon Valley Bank crisis. My friend Juan is nodding from startups from Mexico. Yeah, right? By the way, there are a lot of seasoned folks, investors, advisors in the audience as well. I want to give shout out to my friend Henry Wong. Henry, raise your hand, please. He was a co-founder of Garage Ventures and now runs Diamond Tech Ventures. My friend Juan. So good to see a lot of familiar faces here.
So in advising clients, when we're going on the fundraising journey, I always tell them to put on their hats as an investor and de-risk to whatever extent they can, whether it's technology or execution. So from your perspective, what do you perceive to be the greatest risks for startups, and how do you assess and mitigate these risks in your investment decisions, and particularly in uncertain, volatile markets like we're in?
Yeah, I mean, for us, it's time to revenue, time to customers right now. I mean, I think we are more than ever looking to the customer as a validation. And if a startup doesn't have a customer, isn't generating revenue, that's a very large challenge. I mean, we want a customer to come to us and say, I can't live without this. I mean, we're going into and continue to go deeper into a recession. How long is it going to last? Inflation is there. You know, this isn't a time for often novel tech to really do well. This is the time for cost-saving tech. And you want the customer to come back to you and say, I can't live without this. I don't know where these guys have been, but since they've been here, my life is all butterflies and rainbows.
And what are you pushing, growth or profitability?
I mean, initially, since we're early, we're not looking for profitability. What we're looking for is revenue, customers, and customer feedback that's going to give us the confidence that they can go out and capture share in a very difficult market.
I'll answer the question from a slightly different perspective, which is what is the most common mistake startups make and how do they approach it, which is a flip side of thinking about what is the greatest risk there. Steve Jobs was asked what is the secret to the great products that he built, and he said the answer is it's easy to say yes, it's difficult to say no. So you have to say no more often to what you're doing. In other words, stay focused on a very narrow set of problems that you're trying to solve. Whether it's building a product, features, go-to-market execution, team building, regulatory risk, technical risk, whatever the aspect is, narrow it down. In my experience as a venture capitalist, I have never seen a company fail because they went too narrow. I have seen many companies fail because they took on too much. And so I would say that's the greatest risk. And when I talk to founders, I try to understand, are they truly focused on a very narrow thing that they're going to become the best in the world at?
Let me add the perspective as a strategic investor, right? When you're pitching someone like myself and Experian Ventures or any of the large CVCs out there today, when you're pitching to them, you're trying to figure out why is it important to the CVC, right? Are you solving a problem that they currently have? And they generally don't obviously go early. So they're looking for partnerships on top of potential investments. So I think to the points that he's made, if you can figure out what the CVC's interest is, what problem you're solving for them, as opposed to coming to them and saying, this is why we're going to destroy you, right? And that's a lot of the pitches we get, like we're going to replace the credit bureaus. And no one, always has these perceptions that they're going to be the next generation of the credit bureau. And that's not like the opening line you want to have when you come pitch me, since we are a credit bureau, right? So you have to think about the audience and trying to figure out what's the most interesting angle for them to be a partner and strategic investor, at least as us, as CVCs.
I think the fundamental risks remain the same for startups, but now startups are going to be on steroids. Everything is going to get accelerated. Your timeline to next funding round, like we discussed, is going to be accelerated. And keep in mind, the tech industry as a whole, not just the startup, the tech corporate ecosystem is also going to a little bit of a downturn. So for them to give you dollars for pilots and then for production, et cetera, is going to be tougher. So we're going to actually see the real die-hard entrepreneurs come out of this successfully. There will be startups that will not be able to make it through the valley of death, but there will be other startups that will actually consolidate. There are some startups, one of our companies, portfolio company Unifor, is actually using the opportunity to consolidate. They just acquired 2 companies. And number 2, they're going to customers and saying, hey, I'm going to be the only game in town. Today, I am 60% market shareholder. Here is my roadmap. I'm going to be 90% in 2 years. So this is also an opportunity for startups to start looking at strengthening their leadership position in the market and going to customers and saying, hey, how do we accelerate?
Right, and just to add to that, this is often a very good time in a downturn in the Valley. I've been through many of these cycles for you as entrepreneurs to get out there and do it. Number one, talent has just become available. Meta just laid off thousands. Google's laying off thousands. It just lightened the talent load for you as an entrepreneur. It also gives you the opportunity to go out and get often much, much higher quality talent than you would have been able to afford, because now these people are on 6-month, 1-year, prepaid exit packages right now. So there are a lot of risk that can be taken with some of these folks. It's also meaning that a lot of those folks that had ideas and were just too lazy or too employed to do that are now going to have to start those. So, it's a bit of a double-edged sword, but as an entrepreneur, going out and grabbing those people right now while they've got their own personal runway is very, very helpful. I just spoke to one of our CEOs today. He's in negotiation with a high-level biz dev person from Meta that's going to bring a huge book of business to that person. And that they were laid off a week ago. They're worried about what their next thing is. Being able to come in and snap them up that quickly, I think, is going to serve them very, very well.
Yeah, I think we've seen that in all the cycles through Silicon Valley, that this is an incredible hiring opportunity. And startups that start during those downturns or start actively recruiting have typically done very well. So as you look at the sectors so far in 2023, what's hot and what do you anticipate being hot in 2023? Are there any verticals in some of these sectors that may have new things like the conversational AI that you think are really going to pop out here? What's your big bet? What are you guys betting on for the future?
So we're very excited. We're very excited at this point about going back to clean tech and other areas. When you look out at the broader economy, there are areas that are very resilient. Energy is very resilient. Certainly healthcare is a big spend that we're very active in. One of the areas we really feel excited about is our continued push into food and agriculture. There are a lot of areas of inefficiency, supply chain issues, so there's a lot of opportunity there as well. We tend to be a little less hype-focused. I was joking with my colleagues, we had an exit in AI during one of the prior comings of AI, so we probably won't go back there anytime soon. But, don't get sucked into it, because just as we've seen over the last couple of years, if your pitch to us starts with, "We are AI," then often you don't get much further than that.
For Experian, we're obviously very much focused on everything in and around the financial services sectors. For us, I think, when you think about the industry in terms of size and market opportunity and you compare and contrast it, I like to think about it in terms of GDP dollars, right? You think about from a GDP perspective, financial services is the single largest industry in the US. It's ahead of healthcare. The fact that it touches so many different industries ancillarily related to that with the other products and services, whether or not it's just core technology around fraud and identity, or whether or not it's around payments, or you name it. What we've seen now is sort of a transition away from a lot of these startups that were trying to go direct to consumer with the next PFM or sort of consumer app in the financial services space. It's actually incredibly hard to build that as a durable, sustainable business, because the customer acquisition cost side of that equation is very difficult to maintain. So I think we're seeing a lot more of the transition to more B2B plays, B2B infrastructure plays, and I think that's where we've been focusing. We've also done some stuff in the crypto space, but that's more opportunistic, and largely because there's a lot of large financial institutions that you guys may have read. Large financial institutions are opening up their business to be able to custody crypto and type assets like that, and that's just a wave that we assume is going to continue. So we're trying to figure out how to provide traditional services that we have historically to those firms that are adopting that as an asset class.
Are these companies doing it better, quicker, cheaper, faster, or are you seeing disruptive technology?
There's a combination of both. Yeah, it's fair to say that. There's some that are just they're trying to ride on the back of open banking rails, for example, which makes everything better, cheaper, faster.
I think we are going to start to see the creation of a limitless economy. If you size an economy today for any nation, it is GDP per capita multiplied by capita. And in that GDP per capita calculation, you're typically limited by the skilled workforce, human beings that you can train, who can contribute towards GDP growth. Now, we're going to really start to see the entry of the AI workforce. So because of that, you're no longer limited by human beings contributing towards GDP of a nation. Think about it. ChatGPT is already writing code. It can write poems. It can write books. So it's already doing things in addition to whatever human beings could do. Now you can argue it's either replacing humans. All of that you can argue, but humans will end up doing other jobs. So now you have all of a sudden increased the size of your workforce beyond humans. So because of that, I think we are going to start to see GDP numbers grow to an extent where we haven't actually imagined. So when we talk about comparison of different nations, which nation has the biggest GDP, you're going to start to see which nation has the biggest AI workforce, and hence which nation has the fastest path towards a limitless economy.
I agree with the observations of my panelists here in terms of the traditional vertical way of looking at sectors and also the disruptive nature of AI that Sanjeev points out. I'll add another perspective to why I believe there's a unique set of opportunities that exist right now in Silicon Valley by looking at, of course, the fact that this is Silicon Valley, because a lot of the disruptive semiconductor work was done over here, and then computers, internet, all of that has been developed literally within miles of where we are sitting, with the following observation. Most of the previous work that was done, there used to be one layer in the stack where there was a lot of innovation. And then everybody else worked around that, and companies got built around it. So when networking was invented effectively by Xerox PARC, Ethernet, there was a bunch of networking companies that came out, and then it kind of became a mature, stable business. And we can talk about the same thing in terms of chips, fabless semiconductors, et cetera. Now, we have a unique time when all layers of the computing stack are being simultaneously innovated. I've never seen this before in history, and it's a uniquely exciting thing to think about. At the chip level, the x86 is no longer the dominant architecture. Even MIPS is no longer the dominant architecture. We don't quite know what is going to be the dominant architecture. What really is the best way to run these AI workloads, cloud workloads, mobile workloads? It's all being invented over here. Turing Awards are being handed out to people like Professor Hennessy, Professor Patterson at the chip levels, at the architecture. Right above that, we have the operating system level. Microsoft has abandoned their Windows monopoly. They have a completely different strategy now. Many operating systems are simultaneously being used. Obviously, we use iOS, Android, Linux. All of these operating systems are being used, and then many versions of them, like Docker, et cetera. The middleware layer above that, lots of innovation. The cloud is basically that middleware layer. That's really where all of that work has been done. A multi-$100 billion business has been created between Amazon AWS, Microsoft Azure, Google, and then the seven dwarves, who are trying to copy what they've been doing over there. And then, of course, at the application level, there is a lot of innovation from the user perspective in terms of how we solve business problems, why B2B SaaS has been such a disruptive area, leveraging things like AI, et cetera. I could go on, but I just wanted to layer this out over there, that the fact that this is happening simultaneously is unprecedented and creates enormous opportunity for startups.
Great, thank you. So let's just switch gears for a little bit. And as you think about the successful exits that you've had for your portfolio companies, can you think back and tell the audience here what made those opportunities, initially attractive to you. What was it that drew you to those companies? Ashmeet, do you want to?
Sure, I'd like to start with a very simple example of one of my companies, Signal FX. I was the first investor. Series A was led by Andreessen Horowitz. I can't remember, it was CRV or General Catalyst that led the Series B. And eventually the company was acquired for just over $1 billion by Splunk. So in many ways, it was a very successful company, of course, a good exit for me. And in many ways, this is the quintessential Silicon Valley story. If we didn't build a sustainable long-term company, and people will probably not remember Signal FX 5 years from now, 10 years from now, it wasn't an IPO. Yet, $1 billion, it's real money. I mean, there are people who can afford private jets now because of Signal FX. So in that sense, it's a very interesting Silicon Valley story. Why did I invest? The two founders came from VMware and Facebook, very technical, business savvy, had the ambition, had the hustle, and had a very interesting technical insight. They observed, they came to me, walked in when I met them, and they hadn't even incorporated yet, and said, you know what? This whole movement towards the cloud and all of these things that we are seeing in terms of SaaS companies dominating means that the way people monitor is going to get out of date. Traditionally, monitoring has always been a static definition on which you measured a number. It's going to become a real-time world. It's going to become a streaming world. It's going to be an always-on world. And so we are going to build a better way to do that. And I was like, here's my check.
So you invested at the ideation stage based on the
founder and
business
the idea.
the technical business. They had the trifecta there,
Well, it's always a very subjective and a difficult decision when you look at a founder who has literally a piece of paper and is asking for millions of dollars to say, is this a person who's going to build billions of dollars of value? And there are often contradictory signals over there. So for example, great founders are many times hard to work with. Not all of them, but some of them can be very hard to work with. So you make a reference call and they say, you know what, that guy, he's a real, star. Okay, so what do you do when you get that as a reference call? Is that a good sign or a bad sign? Exactly. So you get contradictory signals at that, and that's why I have a job. That's why venture capitalists exist, and is to look through that signal, look through that noise, and find the signal. No pun intended with Signal FX, to find who is really a person who is going to have the grit, who will persevere, as Sanjeet observed earlier. We will separate the tourists from the real missionaries who are over here, who are actually going to try and build a company. That separation will come very quickly now.
I think, I did a fireside with Kapoor from Andreessen Horowitz, and I think he sums up what you're saying. He said, we look at the idea, and we say, do we think it's a good idea? We then look at the TAM and say, is it a big enough TAM that if they crack it, it could be a really big company? And the third thing is, that entrepreneur sitting in front of us, do we think he or she can execute on that idea? And that's kind of what you're saying.
Yeah, I mean, the four criteria that most academics describe venture capital deals on are the three criteria which you've mentioned, of course, namely market size, founder, and competitive advantage or technical insight, et cetera. And, the fourth category, of course, is what's the deal? Because at the end of the day, I'm trying to buy low and sell high. So you've got to have a deal that is compatible with the nature of venture capital and matches the structure of venture capital. And people often miss the subtleties of that. It's a very fine art, which has evolved over 50 years of hard-earned practice. The very first venture capital firm in the world, ARD, American Research and Development, had a spectacular initial investment. Anybody knows what was the investment that was made by ARD very early on in their life? Started, by the way, to the point that Rob was making earlier, by a French immigrant who was a professor at Harvard, who was the founder of INSEAD, the first business school in Europe, who was a general in the US Army, who had volunteered and worked in the US Army, rose to the rank of general, and then started the very first venture capital firm in the world, ARD. And he made an initial investment in a company called DEC, Digital Equipment Corporation. He bought with an eventual investment of $1 million, he bought 70% of DEC and returned 3,000 times his money on that initial investment. And that company went bankrupt. ARD went bankrupt. why did ARD go bankrupt after making such a spectacular investment? Because they didn't get the structure of venture capital right. ARD was a publicly listed company. They went public. They went an IPO. All kinds of problems came because of that. So Silicon Valley is a deeply nuanced, highly sophisticated model that has evolved over the last 50 years. And one of the very important elements of that is a great deal.
Alex? Oh,
Yeah, no, I'll give an example. For us, obviously, as a strategic investor, the driver was around what we were trying to build on a product called Boost. So if anyone has seen the commercials with John Cena, you might know this purple cow, right? So the genesis for us as a corporation was to figure out how do we launch this Boost product and all the value proposition that it brought to it. As we looked through that, we needed to find a company that was in the space of basically financial aggregation through open APIs, and there's a couple of them out there. We happened to come across one called Finicity. So Finicity was an investment that was driven in order to support the capability we needed in order to launch Boost. And so after we went through all the diligence, looked at them and compared, the ironic part of it is that there's a bigger competitor out there that probably everybody knows the company's name. I just won't promote them on stage here. But that being said, we ended up investing in Finicity because they met our needs, meaning there were certain strategic aspects of the relationship and the investment that we wanted that would benefit Experian. Fortunately, as things went out, things went very well. The Boost product's done very well in the market, and then lo and behold, Finicity ends up getting acquired by MasterCard. So that was a great exit for us, both financially and strategically. And so as Experian Ventures, as part of Experian, our mandate, again, is dual mandate. So yes, financially, great return. Strategically, a massive return for us that you can't obviously measure. But I would add one comment to your sort of structure, the 3 or 4 elements of people. Obviously, we invest in people first, right? So we got to make sure that we trust the management team and believe in the management team. There's an element in there, though, about management team is the concept of coachability, right? That's the number one thing that we always find is how coachable is the team and or, the CEO and or the team. So many times you might find a brilliant entrepreneur, great technologist, et cetera, but if they're not coachable, then you have a much bigger problem going on down the line. Because don't forget, it's not just an investment today. It's this long-term relationship that's generally like a marriage, however you want to describe it as the analogy, that's very long in time. And so if you want to get into a relationship, which is a very difficult relationship from the very first date, you may want to think twice about getting into that relationship. So coachability is an incredibly, I guess, underrated, maybe appreciated.
What are the warning signs that you see where you look at them and go, yeah, I just don't think they're coachable? Any warning signs that you kind of see?
Yeah, I mean, we kind of add a whole level of sort of labels to that. We look for authenticity, humility, honesty, transparency, all of these things out of our founders, right? So, not only are those core, sort of pillars of the baseline that we look at, we dig a lot deeper, as my colleagues are saying, into the founders themselves. Can they execute? If things go horribly wrong, which inevitably they will, you should just plan for horribly wrong, and then everything's gravy after that, right? How will this founder adapt, right? Are they so deep in their mindset they're not going to be able to do that? Then the other piece, which often people don't like to talk about, is what we call the electricity factor. We use all kinds of analogies, Joan of Arc, Moses, the ability to attract and recruit people that are far more experienced and successful and capable than even you as a founder, right? That's why when I'm talking about Meta and Google laying off people, if you can go out there as a founder and convince a former VP at Meta to come, toss their cards in with you, that means a lot to us. And so, you can jumpstart your company, but you can also really show how well you can convince others. And that's what we look for in a founder. We call it that Moses or Joan of Arc factor.
Can I just add one comment to your comment there about he'll invest, I won't? The difference here is that I work for a publicly traded company. I cannot invest in someone who I can't trust that will disparage my brand. My number one job, I can lose $1 million on an investment. I can lose $2 million on an investment. What I cannot capture is if an investment turns bad and you find really bad things about a founder and somehow my public brand is associated with it. To capture the impact of that, I'll lose the $1 million. I'm okay missing out on a 100x opportunity, a 1000x opportunity. I will not put my brand at risk.
Yeah, we lost patience for obnoxious founders many, many, many years ago, right? So, just erase that thought press. We don't want brats. We need people who are going to play together, that are going to do well and not embarrass any of us. Life is too short.
To answer Roger's original question, so we have had actually one exit every year, and luckily, we'll see for 2023, maybe may get tough. But I'll give you examples of 2 exits that have happened under UFirst Capital. One is a company called Pensando, which was created by a famous Cisco MPLS team. We invested in that company. The company got acquired by AMD for $1.9 billion last year in April. And to Ashmit's point that the entire stack is getting disrupted now, that's actually part of the reason why AMD acquired Pensando. And if for those people who are familiar with the chip world, x86 has been the ruling architecture. But with ARM and other architectures floating around, I think the jury is out for the future. So that was a great exit, number one. Another company called Orb Intelligence got acquired. We wrote the first angel level check into the company. 2 founders, they had created a company in the past called Tweeted Times. They would take tweets and create a daily newspaper out of your relevant tweets, send it to you as a newspaper so that you don't have to go to Twitter. They exited that company to a corporation, and then they wanted to start this company. We just believed in the founders, and this was a big data for marketing company. And they exited to Dun & Bradstreet as well within 3 years. Was a very good exit. And, I also want to, I actually really liked how Ashmeet gave the example of the focus rectangle or square, whatever, of Silicon Valley. Since there are a lot of founders in the room, it is very important for founders to understand what works and what that box is for investors, for VCs. And that box has evolved over the past 50 years, as Ashmeet mentioned. But there is a box. You need to understand that. VCs will not invest outside the box, outside that box. And it's a different box for seed versus Series A versus late stage companies. So you need to understand what metrics they are looking at. What are their returns? When you start pitching to a VC in the first 10 minutes, most VCs start to think, is this going to become a $1 billion and a $10 billion company? Does it even have the potential? How will it become that? So you have to start understanding the VC mentality. And they're looking for things like technology sophistication meets accessibility. ChatGPT is a very good example that merged technology sophistication with consumer accessibility. How are you merging those 2 worlds? And when I say consumer accessibility, I'm not just talking about consumers. Business user is also a form of a consumer, keep in mind. So think about it. So when you go pitch to VCs, create a sophisticated story, right? And once you go with that kind of a story, you will appeal much better.
So we're getting close to running out of time. So I'm going to ask a few questions, and let's try and keep it concise.
Rapid fire.
Rapid fire. That's it. So what are some of the issues and mistakes that you consistently see that entrepreneurs are making in their businesses? Let's just 30, 45
overnight,
seconds.
I'll just say one. Overnight, in the last 7 years or so, all startups changed their domain name from .com to .ai. Does not work. and you did a cut and replace. I was a big data company, now I'm an AI company. Just replace the pitch deck. Sorry, it does not work.
Okay, so besides boiling the ocean, what are some of the other mistakes that you see entrepreneurs consistently making in their business?
Not thinking enough about who the customer who's going to write you the check is and thinking about everything else. If you can find me one person who absolutely cannot live without your product, I can show you 100 ways on how to build a bigger business. There are many people, and that's what Silicon Valley excels at. But you, the entrepreneur, is the only person who can come up and find that one person who cannot live without your product.
And to that point, I found recently there's so many people that haven't read the Lean Startup. And so in the little promotional piece, I just had to put it in there because I've seen so many clients building beautiful products that no one wants. So please, if you haven't read that book, I absolutely, suggest that you do.
I think the other one is describing what effectively is a feature when it's not really a business. So many we see, this is basically, they'll pitch it as this is an entirely new business strategy, business plan, et cetera, when the reality is it's nothing more than a feature.
Great.
Understanding how to get to and sell the customer. I mean, I'm just sort of, riffing on top of what all my colleagues have said, but it's all about the customer, whether that's an individual, a business to business, however you want to look at it. How do you get to that customer? How long does it take? How do you drive that? That's what's most interesting to us, because I think from our perspective, when an entrepreneur knows its space well enough to know that customer journey, then they know how to build a product that fits what the customer is looking for. And that's what we're looking for, to the point. I brought this up earlier, my colleagues just did, is again, you can't, especially in this market, you want products the customer can't live without.
Great.
And if you do a financial model by quarter, please don't make fourth quarter of whatever year in the future profitable. I'd say 90% of the business plans that I've seen in that ballpark, for some reason, Q4 is magically always profitable. I'm not sure what this thing is, but it shows up on spreadsheets.
Great. Next question. What are some of the most common mistakes that you see entrepreneurs making in the fundraising process?
They put down billions of dollars of market size without understanding. You should really think through whether you do a Google search and just get your market size from that, or you should do a bottoms-up calculation of the market size. That's a very common mistake, I see.
Tell me what your valuation is when you walk in with your pitch.
On the pitch, I would say, rather than point out mistakes, what I would say is remember the 10-20-30 rule. 10 slides, 20 minutes, 30-point font. Do not use a font smaller than 30 points. That's when you know you have got the essence of what you're trying to say in 10 slides. The 10-20-30 rule works for pitches.
And I'll add to that a great VC who was a bit of a mentor to me, Jean-Louis Gasset, who was one of the first presidents of Apple, once told me the best deck he ever saw was only 3 slides long. So at the end of the day, if you can tell me your story in that short a period, it's that crystal clear, and I can get it that quickly, then you've got my attention.
I turned the projector off after 10 minutes. I'm serious. I do that in the pitch. I say, let's have a whiteboard discussion, because I want to understand what is in the mind of the entrepreneur. Is he or she clear about the idea? Can they articulate? Can he or she articulate it? And because if they cannot articulate the idea and what they're trying to do to me, how will they articulate to other investors, customers, potential employees, and so on?
Yeah, don't read slides. Tell your story. Use the slides for what they are.
I think what I see very consistently is too much information on the slide. You never want to make the VC have to either choose to read the slide or listen to you. Number 2, spray and pray. Never, ever, ever works. I don't know if you guys, when you get the spray and pray email, if you ever pay attention to it. And the third that I see, and I consistently have to coach my entrepreneurs, is to understand the model. I had a VC call me and say, hey, I just want to let you know why we're not investing in the client, because we asked why that number went in that cell, and he said, hey, it's a great question. I'll get back to you once I spoke to the person that prepared the model. Okay, great.
I want to add one last one. This is a little plug for Roger here, which is who introduces you is very important to us. And so, if you don't have a lawyer, talk to Roger. But, trusted advisors, people we trust that have an inherent risk for making an introduction to us is very, very important. Spam emails go exactly there into spam. So the higher quality an introduction you get, the more risk they're taking by introducing you is going to get our attention as well. And that's really the first step. Before you even get in front of the projector or the whiteboard or anything else, you've got to get our attention. So I would encourage you to get great advisors, get good lawyers, make sure your corporate hygiene is in good shape before you come and see us.
VCs do an incredible amount of due diligence on companies and founders, and it always amazes me that founders really don't do a whole lot of diligence on VCs. So what do you think are the 3 most important questions that an entrepreneur should ask a VC before they sign a term sheet?
How can you help me grow? Can you bring me customers? Or will you just show up in the board meetings once a quarter and say, good job, or give me some advice, that's it? So that's one. Secondly, can I have references? Or you can just do blind checks also. Typically, the portfolio companies are publicly known. You should talk to the founders. How is the VC?
I always suggest that my clients go onto the website if we don't know the VCs and do references. Don't ask, just call the CEOs blind and say, hey, how were they in 2008? How were they when things were really bad?
Yeah. And ask them, during the Silicon Valley Bank crisis, did the VCs help you? Were they ready to get you a loan? Because payroll was at risk. Employee payroll was at risk. What did the VCs do for you at that time?
Yeah, here are some
Ask the tough questions. Sorry.
Ashmi?
Ask the tough questions. Don't be afraid.
Here are some tough questions you can ask a VC. How many boards are you on? Which was your last big exit? What's a failed company investment that didn't work out for you? Why? These are all things which will help you understand how you are going to work with that VC. Remember, you cannot fire an investor once you take them. So it's forever for the life of that company. So you really want to choose that partner carefully.
Okay, we'll just let, Ephraim, did you get an opportunity to answer that question?
I mean, I was just going to say, 1, 2, and 3, or let me talk to 3 of your CEOs. Good, bad, and indifferent, right? Talk to someone who's failed, talk to someone who's won, and talk to someone who's just floating along there. Because, the best answer is that. And then just to wrap up on the other piece, make sure you show your deck to a toddler or someone in grade school and make sure they understand it, because that's our attention span. Because you might not realize it, but every one of you are going to send your deck to us tomorrow, and we're going to have like this much attention. So 20-point fonts, 30-point fonts, no more than 3 data points per slide. We're just not that smart, or we're not that focused, or both.
I'm going to get the evil eye here from Rob, but I'm going to do one more minute. Just, how do you work with your portfolio companies? And maybe in a sentence, how do you work with your portfolio companies to help them grow and succeed beyond just giving them money? Just got on the line from Ephraim. 1 or 2 sentences.
We are investing in a company, so we have not invested in that company as yet. And this is a company by a very famous CEO of a large tech corporation. We have taken the CEO to 15 customers, including Department of Homeland Security, including several corporations, including a couple of university CIOs. So roughly 15 customer introductions and meetings have happened, and we have joined those meetings too. We have no ownership in the company today. They are raising a $100 million round. We are investing in that, hopefully.
Great. That's about a little more than 2 sentences. Ephraim?
Hustle hard. We'll hustle hard for you. That's just it. Bottom line. Doesn't matter. You're going to need something, and you don't know where to get it, and we do, because that's what we do.
Customer and talent acquisition?
Anything you need. We're hustle hard. Drinks late at night, after parties, whatever you need.
All right,
we are here for you.
You heard it here first. Anything you need from Ephraim.
We have relationships with every major financial institution on the planet, so our ability is to bring introductions to, if you're in the financial services space, introductions to those potential customers.
I run a craft business, which is a one-on-one relationship with me and that CEO on what they need, where I believe I can help them. I believe I work for you, the entrepreneur. You don't work for me, and I'll do whatever it takes to help you win.
Excellent. Thank you so much.
Okay.
Thanks to the panel.
Is it safe to say the panel exceeded expectations? That was brilliant, compelling, dynamic, entertaining, and scintillating. Right? Well, 3 out of 5 ain't bad. That's actually, this is the first in-person venture capital panel we've had since February 13th, 2020, and that's the last time I saw F in person.
I got COVID at that event. I was an early adopter. I just want everybody to know.
So I feel like I am entitled to expand on one of your comments.
You look great, Rob.
said
You
that,
really look great. He
you said
plays
that people
tennis
need
way
to-
too much.
You said people have to work on their corporate hygiene. They should drop the corporate from that phrase.
Okay. Who likes online better than in person?
I do. They're easier to do.
1. Okay, Rob. Exactly. Rob and I were having this conversation before, and he's like,
Well, you go to Costco and pick up the water. All right, now it's time for audience participation. So we have a mic stand set up. So if you have a question for the panel, walk up to the mic stand. We want to set up a line. It'll be really efficient. We have half an hour. This is not a pitch event, so no pitches, no thinly disguised pitches. And if you deliver a pitch or a thinly disguised pitch, Joe, our bouncer, will be there to deal with you. So be forewarned. So question number one, go for it.
I hate to do this. Because this is completely nerve-wracking. But I wanted to talk about 51% of our population, which gets an incredibly small number of dollars, venture capital dollars. I was recently at a women's business conference, and I heard that that percentage was as low as 2. I didn't look that up. I have also heard that female founders are often encouraged in order to get venture capital money to find a male co-founder to make getting money easier. And I definitely heard all of the check amounts you guys said that you write. So I am curious to hear from your perspective, what is causing the issue, the blockage? How can we change that? Maybe anything that you guys are working on to do that.
It's just, this is a great question. And, this reminds me a couple years ago, we were at a panel. I was at a panel discussion. I think actually, Sanjeev, you were on the panel. And a Wall Street Journal reporter asked us a very similar question about diversity in Silicon Valley. And, those are always loaded when the Wall Street Journal, someone that's like minefield, you got to be careful. And I remember, no one wanted to answer. And the moderator was like, well, after you got to take a shot. And I looked down the table just like I did today. And I said, and sitting next to me were basically VCs from every country, every race, every gender there were possibly. I said, look, if you know a place that's more diverse than the table you're looking at right now, you let me know. And what I will tell you about female founders is and I think all of us will look at the same thing. We are founder agnostic, right? The problem is not us making choices. The problem is what's put in front of us. And I think the proof point lives in the fact that the companies that we fund, the exits around there, we've got founders from every possible walk of life. So for us, it doesn't matter. If your dog could come and pitch us effectively, and we believed the market segment was large enough and had the customer traction, we would fund your dog. So this isn't our issue. It's what's put in front of us. And if you look at, I think the data point that needs to be looked at is the deal flow we receive, what percentage of it is from, for example, female founders. And we're actually funding 2 or 3x the percentage of the volume we get. So it is a systemic problem. And if it doesn't rise up to our level, you can't ask us to fix a problem that the fundamental society will do.
I don't think there's going to be a solution to this problem tonight, right? I'm a recruiter, and so I have a very similar thing when companies come to me and say, hey, we want to have more diverse employees, right? Similar thing. I can't go and create someone with a computer science degree that didn't get into that college in the first place. But in the recruiting industry, for example, we're doing some things to try to build that pipeline. Is there anything any of you guys are doing or anything that anyone can speak to about that?
I'm very proud to say that in my personal portfolio, which is very small, I have 2 women CEOs, both founder CEOs right now, which is, I think, batting way above the 2% statistic. That is roughly where it is. But I will add that this is a problem which is, it has many dimensions to it. It is not a unidimensional problem by far. I am certainly not an expert at addressing many of those dimensions.
And just FYI, we have found that historically female CEOs do much better than male CEOs. So from our standpoint, this is as big a problem for us. So we found them to be much more efficient at running the business than often male founders. So from our standpoint, someone needs to fix a problem and then we'll fund it.
We have invested in female founders. I talked about the exit Orb Intelligence. It's created by a female CEO. But talking at more at a VC industry level, the problem is real. And I do believe there is a bias. So I'm not going to put it under the carpet. Number one. Number two, I think there is a multidimensionality about this problem, like Ashmeet said. But I think one of the key factors here that will drive change is the male mentality. And it stems also from how you are brought up. So it's actually a deep-rooted problem. It's not that all of a sudden somebody becomes biased, right, at an adult age. So there are a lot of levels of problems on this. My daughter, who is a freshman in college, raised a venture capital fund to try to address this problem as a high schooler. And I learned actually so much about this problem. She talked about her experiences as a middle schooler, then going into high school, how boys would put her down. You cannot be successful, things like that. So there are a lot of things that we have to do at a young age to be able to solve this problem. And it's not just in venture capital, it's in Hollywood, it's in several walks of life. But let's do what we can.
Go, girl, dad.
I think there's an aspect that is multidimensional, and it's obviously very difficult to address singularly. My investments over the years, I've done the calculation, the C-suite for me is about 12%. So I don't know if that's good or bad. I can only tell you that's a math number. It's a byproduct of 2 data points, right? Or not 2 data points, but the data points. But I don't know how to solve that problem. I would say to the top of funnel, that's an aspect of it. But there is a lot of initiatives out there, right? There's a lot of initiatives now relative to where they were a year ago, 5 years ago, 10 years ago. That I think ends up opening up the top of funnel, making it more sort of, why is it so low, right? And if that's what the hammer is to solve this problem, then that's a fine place to start, right? Because where it was just didn't make sense, I guess.
Great question.
Thank you very much.
Thank you for bringing up the topic.
Thanks for the panel. My question is probably a lot easier. I'm probably interested in hearing from each one of you about the top 3 areas you think are hot for investment, or when you get an email, at least in your inbox, you're like, oh, this is an interesting, for 2023, what's your top 3? And I know each one of you is at a different phase in the funding process, but I'll be interested just to see, is it clean tech, is it this, is that, where would you?
Solving real problems, generating revenue, and being above the fray.
We are quite broad within the B2B software, but we try to limit ourselves to B2B only. Within that, we've found that applications leveraging real AI and driving customer impact, that's one impactful thing. Second, we feel developer is going to be at the center of the universe in the PLG world, product-led growth world. So new tools or new angles around developers would be helpful. DevRev is one of our investments along those lines, right? So I think those 2. And number 3, I think cloud has reached a sophistication level, but the next gen improvement level in the cloud needs to be seen at a 10x step up level. So we're looking for companies that are thinking, hey, what next?
Top of mind would be anything and everything related to payments. The payment disruptions that are happening globally on the back of PixPay down in Brazil, FedNow in the US, all the other things, real-time payments is one. Another area which we are spending quite a bit of time on is everything in and around the broader landscape of fraud. Just as you can imagine, thinking about quantum hacks, for example. So, and us being a credit bureau sitting on large amounts of data, that becomes probably above the first one. So I think anything in and around fraud and fraud protection.
Rather than talk about sectors that are hot, I think it may be more interesting to talk about problems that I see where there is opportunity for technology to solve them, which is how I always view venture capital or the opportunity for entrepreneurship. The first and most obvious one, of course, is this entire problem of cyber. We live in a digital world which is highly insecure right now, and we are under threat from both commercial and nation-state actors who want to take advantage of this situation. There is an enormous amount of money at stake, and there's an opportunity for companies to do it. The second area I would mention is related to that. AI is, of course, very powerful and disruptive. We don't know how to make AI safe. So the whole area of AI safety, robustness, is going to be an enormous area of investment and opportunity for companies. At a deeper level, Moore's law has ended. As I observed earlier, there is no default understanding or acceptance of what is the right computer architecture. If you change your assumptions on what is the architecture of a computer, is it a TPU, is it MIPS, is it an x86, how do we think about this problem? That changes all the assumptions on how the entire roughly $1.2, $1.5 trillion a year IT stack sits on. So enormous amounts of money at stake in terms of getting that right. And if an entrepreneur has a new technical insight, a new idea, a new way of thinking about the problem. It doesn't matter if there's 100 existing companies. There were 100 search engines when Google was started because Larry and Sergey came up with PageRank. Nobody knew how to connect computers effectively when Bob Metcalfe came up with Ethernet. So when you have a new idea, when you come up with a new way of solving with technology, you can literally change the world.
Great. Next question.
Hello, I'm Ezekiel Price. I'm from the South. I have two questions. Somebody said earlier, separating the missionaries from the tourists. I was curious as to what that means, because it's very interesting.
Yeah, I'm the person who said that. The usual way to phrase it is to separate the missionaries from the mercenaries. That's the way most people talk about it. Mercenaries meaning people who are trying to do something to make money. Missionaries meaning people who have a sense of mission, who are doing it for a higher purpose, a cause. And the usage of this, as I understand it, English is my second language, but as I understand it, is very old. It goes back to religious times, maybe the Crusades, or I don't know. I really don't know where it goes to, but it's a very old usage of the language. The reason we want missionaries and not mercenaries is because mercenaries are, of course, short-term focused. They're trying to make a profit themselves, whereas a missionary will devote himself, his entire life, or her life, to make and achieve that cause. And so, of course, you would much rather have a missionary than a mercenary. And the reason I made the tourist reference is that it's my experience that a lot of mercenaries in Silicon Valley are actually tourists. They're quite literally, physically people who came from outside, who don't want to make this their home, who are just here because it's school, it's an opportunity, it's because they think they can live here for 5, 10, 15 years, get rich and go away. It's possible, it happens, but that's very different from someone who is truly a geek, a nerd, a Silicon Valley resident who is trying to change the world.
I see this quite often with clients and also companies I invest in, where you see these individuals that are looking for a problem to solve, as opposed to founders. I think the best founders that I've invested in and that are great clients are those that have felt the pain, personally, and they've found a solution to address that pain, as opposed to just going out and looking for a solution to try and solve it.
Early on when I entered the venture capital field, I used to think that most entrepreneurs are doing it for money. Then I realized after interacting with a lot of entrepreneurs, actually most of them don't even care about the money part. They really want to make an impact. So that was the transformation I went through as an investor early on in my venture career.
Thank you very much. The second question I have is a little bit more of an educated question. So when you're looking at tech hubs, you can think of Silicon Valley, you can think of Austin, you can think of North Carolina, maybe Boston. But in the South, there really isn't. They're trying to push for more. They're trying to push for tech, get more kids into STEM. But it's really not. It's not competitive. So how do you? If I want to figure out a way, because me personally, I'm out here in Silicon Valley. I'm from the South. This is not like my comfort zone. It's a little bit of a culture shock. So, I think we have some brilliant things to offer in tech, but they just don't have the infrastructure set up in the South to compete. So what would be, if there's a brilliant amount of talent, there's competitive people, there's thoughtful people, there's, go-getters. How do we utilize them to, get some of the same problems solved, but, they're just in a different region?
Well, I think tech hubs have fundamentally sprung up around different things, and there are plenty of them in the South. It's trying, and I actually have a former partner of mine who's in South Carolina, and they're doing a lot in Charleston. However, there are a lot of pieces that go into creating this. There's a university infrastructure there, and there are plenty of tech hubs in the South. Atlanta, Raleigh-Durham. I mean, you can go on and on and on. The issue really comes down to getting these pieces. So you can't fundamentally spring up a hub with an infrastructure without some of those core pieces. So, you know, if you don't have the multiple university systems, you don't have those pieces, then, you know, capital, legal, all the other pieces trail behind that. And so that's why Silicon Valley, that's why we have all these deals. That's why Silicon Valley Bank crashing is so important, because you have to have all these different pieces. Now, you know, there have been companies and countries that have tried to recreate that. And, you know, it's fundamentally very, very challenging to do so without those, pieces. So to me, this is not, let's go look for them. They're there, go support the hubs that exist.
You know, Silicon Valley, as they say, Silicon Valley is not a place, it's a mindset. Right? Can you replicate Silicon Valley? Yes, if you embrace the mindset. It's a mindset of risk-taking. It's a mindset of embracing failure. It's a mindset of wearing failure as a badge. We get resumes, you know, somebody says, I've done 4 startups, all of them failed. One of them raised Series A funding. That's the best I could do. And now I'm creating my 5th. And they get funding. Won't happen elsewhere that easy.
If you're interested in studying this deeper, I recommend studying the Creative Destruction Lab, CDL, which is a research project of the University of Toronto. They've done excellent research between the economics department, the business school, and the engineering school on why there is only one Silicon Valley, and what would it take to recreate Silicon Valley in Canada. The papers are astounding. I am an associate, so I'm part of the work that is going on over there. And we don't have enough time to study it over here, but there are many things that have enabled Silicon Valley to be the special place it is. And so I'll end by observing the following. If your goal is to create a Silicon Valley or make the South a better place or create a new tech hub, etc., then this is a relevant topic. I just want to make sure if your goal is to become a great entrepreneur, you don't have time to think about any of this stuff. Just go on and build a great company and think about that customer and revenues and technology and team, and those are the things that you have to think about. Even Mark Zuckerberg, who is arguably one of the greatest entrepreneurs, had to move from Boston over here. That wasn't an accident. To build a great company. So you really don't have time to do that. It's just to focus you in sort of what really your goal here is. If your goal is social, political, legal, you know, to make the world a better place, then that's a different aspect.
Yeah, VCs are lazy, and you know the old joke, right? Which they want to invest in companies that are within 30 minutes from their office, right? So, which now is probably a charge in your Tesla or something. But
you know, your question reminds me. There is a successful CEO. We asked him, "Hey, why do you think Silicon Valley works?" And we took a list of 10 to 15 reasons. He struck out all of those, and he wrote with his pen, "Ad hoc meetings." And he said, "That's it." He said, "I get so much business done. I have hired my best employees via ad hoc meetings, just meeting somebody when I drop my kids at school or in the grocery store or when there was no planned meetings." Because we are surrounded by people with the same mindset.
And obviously what happened when 2020 is nobody traveled anymore, but we still did deals. And so I think everything has, by default, been diffused into more efficient locations.
And just FYI, more than 50% or 60% of our portfolio is not in Silicon Valley. So, you know, don't get spun around this. You may have to come here and visit, and your lawyers may be here, and your venture backers may be here, but you don't have to be here. I mean, I've got 3 or 4 portfolio companies in the greater Denver area. You know, I've got one in, Seattle. I've got another in Arizona. So, try and choose places that the travel's nice. I mean, that's important. But otherwise, it doesn't really matter. It's just you need to come here to take advantage of the infrastructure. Some businesses have to be here, others don't.
Thank you. The one thing I will just say from having clients all over the country, the velocity here is different. And the fact that you've got so many serial CMOs, CEOs, or whatever, the talent pool is just unlike Austin or Boston or anything. It really is amazing. But thank you for the question. We've got a couple more, and we've got 5 minutes, so let's make sure that everybody that's got a question can get one answered.
First question or the second question?
Which is the most important one?
More controversial one first.
Yeah, so we're going through a very unique time right now. By the way, my name is Zeki. I'm the CEO of Creative Technology. Fancy beard is here. We're going through a very unique time and living in a very unique place. Diversity, inclusion. I mean, we're not living in a real world in Silicon Valley.
Is this a question or is this a statement?
This is a question. This is a question. So, what do you think is going to be happening through these unique times, and how long this recession is going to be lasting, given the upcoming elections, given the polarization in the world for semiconductors trying to move back here? There's a lot of things going on at the same time, and we have been through this unique times before, but not as unique. So what's your idea?
You know, the political stuff doesn't really bother VCs and entrepreneurs, honestly speaking. They have their political beliefs and all that, that's fine, but that really doesn't affect the companies that much. I had a friend who runs US India Business Council, lives in DC. He was visiting here, met a lot of VCs. We had lunch with him, and he said, I'm finding nobody cares about what we do over there. Here in Silicon Valley. I said, yeah, probably true. So anyway, so that's the answer to your first part of the question. Other things, you know, I think we're going to see big changes. We're going to see, I don't know, Silicon Valley 3.0, 4.0, whatever you want to call it, in terms of what gets funded, what doesn't get funded. And also in terms of what corporations embrace, because corporations are going through big changes also. The boardrooms are asking tough questions right now. So what gets funded from the corporation side? Who gets the pilots is going to change. So nobody knows what exactly will happen. But we are going to see a whole new way of how companies are built. And as expected, the pace of innovation will be 10x of what we have seen till now, maybe 100x.
Yeah, I think we've all been in venture capital through cycles, and all I would say is that they come and go. Sometimes they're longer ones, maybe a year, maybe two, what have you. Just know that I think last year obviously was a horrible year on the down cycle. My personal opinion is I think 23 is kind of where we try to find the bottom in all this activity on venture side. But bear in mind, there's literally records amounts of dry powder sitting in funds that haven't been deployed. So they would love to sit around and collect their 2% management fee, but they actually have to deploy that. So it's just they're trying to find bottom, and I'm not too worried about it because, as I said, we have been through multiple cycles, and yet I'm still alive, and so the entire industry is still alive. It's much larger than it was 5 years ago, 10 years ago, 20 years ago. It's just a blip. If you can tough it out, it's a really difficult time, obviously, but this is where you find the real business models that have durability to them, and that's obviously healthy.
Fewer companies are going to get funded, but more dollars per company are going to happen. There is a company our portfolio company that went out to raise Series B, $20 million was their target. The VC said, I will invest, but my check size will be $23 million, so can you increase the round size? So they ended up, finally, the round is closed. They closed a $30 million round with $22 million from one VC. When VCs find good companies, they want to go bigger.
So one thing which is different about this cycle is that for most of Silicon Valley's life, we were basically just an ATM for the politicians. And most of the country didn't care about us. We were the nerds, the geeks, we worked on cool stuff, but at the end of the day, we gave them money and they were happy and they went away. Unfortunately, starting roughly about 10, 12 years ago, I think Mark Zuckerberg, et cetera, made a big mistake because now we have touched the nerve of power. And people understand that power flows through Silicon Valley. Power meaning political power. And so that is going to inevitably and in my opinion, in a negative way, change the way Silicon Valley works and the way startups will be built. And so you, as an entrepreneur, have to be cognizant of that. Why did Elon Musk buy Twitter is a very interesting question to understand and sort of get to the root of that. So again, we don't have time to discuss it in this forum, but if you're interested in that, I think you should try to answer that question.
Great. So got a couple more people that want to ask questions, so you're going to have to hold your first or second question. Chloe, go ahead.
Thank you.
Hi, everyone. Some of you might remember me from like an hour ago. My question is about due diligence. So I know we've talked a little bit about what we look for in teams of founders and kind of what we look for in companies. What I'm kind of wondering is if there's anything that you more critically pay attention to in bad times versus good times, or what you look at more.
Character, tenacity of the founders. Do they shake as a CEO?
Is more
during
relevant in bad times.
I think those aspects become a lot more prominent in tough times, and the character and the personality of the CEO almost defines the personality of the company as well, and whether you can weather a storm.
Smart spending. I mean, just smart spending. Making good decisions there is really one of the key.
Nothing should change in theory. If I was doing my due diligence right in the good times, I'd be doing it right in the bad times. So theoretically, nothing would change. I'd still ask the same question. I may be more critical and judgmental of the answer, but my due diligence line of questioning wouldn't change at all.
I'll go so far as to say that almost any successful Silicon Valley company goes through at least one cycle, a recession and a boom time. And so you are picking someone who's going to have to get through both those.
Great, thanks. Thank you, Chloe. Next question.
Fine. Or one last question.
Yep.
Make sure it's a good one.
All right. Hi, everyone. Good evening. Great information tonight. Thank you so much. So in the previous conversation, you mentioned that the chance that got found really depends on the quality of the connections who introduce you. So I'm wondering, do you have any suggestion for the early stage founders? Where can we meet kind of the high quality connections, and how do you define high quality, and like why do you put trust to them?
Rob introduces good deals, and I always get back to his people. Roger, right there. You have two people right there. So, I did my job.
I think it's a fair question because I saw it in some of the people's eyes when the comments were being made up here, right? Which was the quality of the introduction sort of lends credibility to the person you're representing, right? The problem is if you don't have that connection, how the heck do you get it started? So I think it's a very fair question. It's unfortunately, it comes down to how well you can network and work your way into that flow of connectivity. But I think it's a very fair question because we answered very candidly, well, if it comes from Bob on the street who I don't know, I don't take it credible. But if it comes from someone at Andreessen's, I'm going to take this credibility. Well, how do you get to Andreessen Horowitz, for crying out loud? If you've never started a company before, you're not a serial entrepreneur, you never failed, et cetera. So I think it's a very fair question. But it does come through events like this and networking, getting to know people. It's just, you got to start someplace, unfortunately, the cold start.
I will just say, I get so many requests to introduce people to VCs. And typically, I don't ever make introductions to people that I don't know, just because I feel like my reputation and credibility is on the line when I'm making introductions. And so, I want a VC to always feel, even if it's not for them, that, hey, I'm glad you made that introduction. So I think, getting to know people and people getting to know you is really important. I did a fireside with Paul Holland and Adi Shirabazi. You should look at the video on Access Silicon Valley. And Adi wanted to get funded by Paul Holland. So what he did was he sort of made all these LinkedIn connections with CEOs that had been funded by Foundation Capital, and sort of getting to know them and getting to know the entrepreneur, and they ultimately, one of them made the introduction to Paul Holland, and that was the best introduction, one CEO of a VC introducing you. So I really think that it's important that you don't just say, hey, hi, my name's Monica, introduce me, just get that person to know you.
Thank you so much.
Can we have 1 minute for inspirational?
Go ahead.
Is there anything for the panel that we haven't talked about that, any words of wisdom, pearls that we could give the entrepreneurs on the road?
Yeah, I mean, this is one of the best times to start a startup in history. And, we always say this, and I just really feel like it always gets better. I mean, mass layoffs make hiring people easier, right? Silicon Valley collapse makes VCs look outside of the box. All kinds of problems in the economy, and COVID and all these lockdowns. That all creates, seams that people can fill, problems that get exposed from that type opportunity. So this really is a great time to solve all that. And as you can tell from what we're saying, there are no things that are sort of outside the reach. The whole tech stack's being rethought, the whole cycle's being rethought. There's no reason why you can't do this now. You just need to go do it.
Great.
Be brave. This is the time to be bold, and don't get intimidated by the external factors, bank collapses, that economy, layoffs, all of that. Look at the positive side. I think, and the best companies come out of downturns, keep in mind.
The perennial optimist, obviously. Hustle. I think your number one job as the entrepreneur is to figure out how to hustle your way into every single conversation, every single meeting you can get, and build that network.
There are only two things in the world that have zero friction and infinite leverage. Software, zero friction, infinite leverage. Once you write it, you can build 1 million copies of it or 1 billion copies of it at zero cost. And the other thing is money. And Silicon Valley uniquely brings these two things together, which allows you to decide what you are going to do with this infinite power that these two things create.
Excellent. I just want to give a really big shout out to the panel. Thank you so much. Appreciate it. Okay, it really is the end.
All right,
That was
let's
it.
give it up for Roger, our awesome moderator. So let's give it up for Procopio and all our sponsors. Let's give it up for the event team and the video team.
How about we give it up for Rob for an awesome event tonight?
Stole my thunder. He's back. And also, I want to give it up for the audience for filling the room. Thank you. So, stick around, network, socialize, and connect. Ideally, we'd like to leave the building by 9 p.m. There's lots of food. Please finish it off, take it home, do us a favor. Now it's time to decide where the after party is going to be. So, once again, choices are A, B, and C. So, number 1, the Rosewood.
Yeah. Want to give a big shout out to Rob and the Idea to IPO team. You've been doing these events for 14 years, roughly?
February 1st, 2010.
Yeah.
Do the math.
Yeah, huge.
All right. So Rosewood, once again, it's Thursday night. Anyway, the patio, Pizza My Heart. They're open till midnight. The only thing is there's only a few things open at midnight. Well, I'll skip McDonald's. Okay, and the winner is Pizza My Heart. So take some food home, network, socialize, and connect. I'll see you guys at Pizza My Heart. So thanks for coming. See you next time.